Okay, welcome everybody. This is another episode with the CFO of ZEPP Health, Leon Deng, who is kind enough to give us the time to go through the Q4 2023 earnings and I guess the whole year, which ZEPP Health just reported. And in this session, I'll go first into a little note that he kindly sent over to me. So this will be a couple of talking points in his own words about the company results. And we can possibly talk on each of these points after elaborating on it. And then in the end, I will go into a couple of questions that I'm getting from the community of retail investors and have my own questions also around these earnings, which if you have watched the markets, investors have not been happy in the first reaction. Yesterday, the stock, I think, traded down up to 25% as an initial reaction to the earnings and recovered a bit later on. Of course, this is also due to the volatility possibly in the market that we currently see around Chinese ADR and also the Fed meeting that we're going to have today. But now let's talk into the fundamentals of this company. Let me open this note, Leon. By the way, I shared this in the Patreon community, and that's some of these benefits that you'll get if you are a supporter of this channel. So you can find a link below to join this community if you're in the $10 tier. And from time to time, we can do some special content like this today with executives of the company, which I really value. So thanks for standing up here, Leon, and taking the time with us. So first of all, let me just jump into the points that you wrote to me. I'm going to read the first one, which is first, the revenue at RMB 0.6 billion in line with our guidance. It's minus 44% versus Q4 2022. The decline is largely driven by Xiaomi branded product sales. Our relative self-branded value market share holds up. In Q4, we ranked number 6 in the global smartwatch market after Apple, Garmin, Samsung, Huawei, and Fitbit. So kind of a nice opener here. I think, of course, except for the revenues, which are down. And I think that's the story of these earnings. Revenue down, but maybe as we'll see a little bit more on the profitability on the bottom line later, right? So anything you'd like to add to this first point, Leon?
No, I think, Marcel, we talked about this before in the previous quarter. That we actually embarked on a transformation journey to transform the company from a Xiaomi sales dominant company to a self-brand, Amazfit branded company. So I give that joke or half jokingly before, right? So we don't want to be a Foxconn. Actually, we want to be a Sony in China, right? So that is actually the long-term vision we would like to become, and that is exactly what we did in the past 2 years, which we were kind of in a transformation journey, right?
Mm-hmm.
That also explain in part why the revenue was a decline versus last year. As I think you read pretty much what I have wrote to you, but I think the color of that is that we kind of prioritize the profitability over the scale, right? So that's one of the strategy we wanna do. So it's basically we value the quality of the revenue versus the share amount of the revenue, right?
Mm-hmm.
So I think that was one of the key things which I would like to highlight here. And if you look at the mix of this revenue, when we were listed in 2018, that more than 70% of the revenue was Xiaomi branded sales, right? And then, okay, I think you guys probably also follow on Xiaomi. The founder and CEO also mentioned that whatever products Xiaomi is making, they only want to make a cost plus 5%. In essence, they don't want to make any money out of any hardware which they sell, right?
Mm-hmm.
And you see that journey throughout from 2018 until 2023. What we notice is that the gross margin profile of the Xiaomi products is actually going down year over year, right, towards that 5%. Right? So that's why even if you have a huge revenue on that part of the product, it does not necessarily would translate into a sizable profit at the bottom line, right?
Mm.
So that was one of the reasons why we embarked on this journey, whereby we say, yeah, Amazfit brand sales should deliver a higher gross margin, and in return, in a longer term, be the core of the company, which is going to cover for all the fixed cost of the company, and then in a longer run can churn a nice net profit out of it. Okay? So that was the transformation which we did, and I think we are quite pleasant in Q4. I think if you look at our Amazfit sales in the overall revenue mix, I think we stand for around 90% of that revenue mix, right? And then if you look at full year 2023, we stand for more than 70% of the whole revenue, which are actually have been booked for 2023. That is quite a comparison versus 2018 when we got listed. 70% of that revenue was Xiaomi, right? So you see that change already in the numbers. Obviously, the next challenge to us is to actually increase and deliver a higher market share in the smartwatch domain. And mind you, we're a wearable company, and I think later this year you will also see different form factors of the wearables, which accompany different products, which we're going to launch as well. Okay? So I think that's a little bit of the color on the number itself.
Yeah. On these numbers, can you? I'm not sure if it was in the reports. I just looked for it, but couldn't find it. Can you share the absolute unit numbers for the self-branded products for this quarter?
I think it's around 1 million or so. It's in the financial statement. I think we called out the units. But if not, I think you should be able to find it in our 20F, which is going to be published early next month in April. Yeah.
Okay, and just to give the viewers who are possibly not following the company that closely, a feeling like how has this number developed, like in absolute terms? Is this I mean, you mentioned like how Xiaomi sales is going down, so we understand the share of the Amazfit products is going up, but how is it looking in absolute numbers? What's the trend here?
No, I think if I remember well, in 2021, I'm talking about RMB number here. Yeah, in 2021, if I remember well, we locked a sales of 6 billion RMB. Right. In 2022, we booked a revenue of around board number of around 4 billion. And in 2023, we did 2.5 billion in RMB, right? So you see the decline on revenue year over year was largely driven by the Xiaomi value. So I think, yes, the decline between 2022 to 2021, so the journey from which we go from 6 to 4, that is actually more caused by the product nature itself, because once you are in a band business, obviously every single form factor will has its sharply increasing period and plateaued, right? So I think 2021 was that year whereby the band sales actually plateaued, and then it started to go down. So I think if you want to get a feeling for the Xiaomi sales, it's the 2022 to 2023 decline, that's 150 million, or no, sorry, because there are different numbers in my mind. So sometimes I confuse the dollars amount versus the RMB amount. So we went from 4 billion to 2.5. So there was a 1.5 billion RMB decline year over year between 23 and 22. I think 80% of that decline was the Xiaomi value. And because of the band market is in sharp decline. So if you look at our own self-branded Amazfit value per se, year over year, yes, there's a decline of around 20%, roughly that ballpark. But that 20% largely has something to do with the strategic shift which I mentioned just now on prioritizing the profitability over the scale, right? So also towards our own sales, we did some channel pruning. We did try to maximize the sales channels which does not make money, and because we try to actually prioritize the profitability over the scale, right? And not to mention, there are two countries which I like to call out. One is India, one is China, right? These two countries, actually, if you look at the numbers which we reported before, yes, we were big in those two countries on sales, but since the competition was also big in these two countries, if you take into account the marketing effort which we need to do and all the other support which we need to give to these countries, because you have to make specific versions for these countries, you have to get it certified, etc., etc. We look at the profitability of these two countries, fully amortize all the cost. These two countries are not making money for us. That's also was one of the transformation which we did in 2023, whereby we prioritize the profitability of these two countries rather than the revenue scale of these two countries. Mm-hmm. And then I can tell you that by 2023 year end, both markets actually delivered a profit to our bottom line. Mm-hmm. Right? But obviously you would pay the price for sacrificing some of, in my word, the low quality revenue, which was in the book of the company in the past. But in the end, you don't make any money to it. Mm-hmm. So that's why I think if you look at that decline between 22 to 23 on the self-branded Amazfit, the 20% decline is mainly coming out of India, China. We shifted the model, plus some of the retail, the KA pruning, which we did in Europe and Asia Pacific and US markets, whereby we cut on some mama and pop-up stores, which in the end, yes, it increased the revenue at first place, but then they cannot sell, and then it will come back to your profitability and eat into your net profit. Right?
Interesting. So this is where so you basically cut back on some, in your view, not so profitable revenue streams for the self-branded products in some of the markets, which were, you made the market entry, you checked whether or not there is acceptance for it, but you found that the channels just don't work as much as in other markets, and then sacrificing some revenue there, but on the end, focusing more on the bottom line.
Yeah.
Okay, cool. That's interesting insight. All right, let's move on to your second point, which was about margins. That's connected to that. Gross margin is at 35%, plus 2% versus Q3 in 2023, and reached another high in the company's record, with self-branded products margin at 40%. Together with the mix improvement, channel pruning, and the new products launches in Q4, Q1, we expected margin expansion to continue in 2024. So a little bit of insight on the self-branded, on the margin. I think that's where the trend is going. The margins have been growing in the last couple of quarters consistently, possibly due to those new products. Maybe you can tell us more about what you've launched in Q4 and Q1 for those who are not so much aware. and maybe talk a little bit more about 2024 in this regard.
Okay, good. Now, so I think on the margin, that's one of the bright spot of the company, and that's also why we have the confidence that in 2024 the company would continue to spin the flywheel, if you may, right? Because you heard me, we try to prioritize the profitability over scale, and that turns into a higher gross margin. Right. And to rewind a little bit, this is already the second quarter in the line whereby our gross margin is above 30%. Right. So 2023 Q3 we hit 33%. Now we're at 35, and this trend is going to continue, and I will tell you why in a bit. Right. So I think what we did, number one is really yes, there's new products which has driven the gross margin up. If you remember, starting from Q3 2023 onwards, we had the balance theory which we launched. The balance is in essence the successor of the GT series which we did before, but we think compared with the others, we should have our specific edge more towards the work-life balance, which more and more people want to strike in their day-to-day life. Right. So balance was one of the lines which we launched in Q3 2023. And then in Q4, we continued the launch active series, which is basically the square version of balance, which we put into launch in 2023 Q4. And we also have launched the active edge series, which is more tailored towards the hip people in the urban life, right? So I think we also looking into Q1. Q1 we didn't have any new product launch per se. And also Q1 is a soft quarter from a consumer electronics industry perspective because Q3, Q4 people go through the Christmas sales and Cyber Monday, etc. And then Q1 obviously for every player in the consumer electronics industry is a slow quarter, right? So Q1, that's also one of the reasons why the guidance which we provided for Q1 is slightly lower than some of you have expected, right? But then starting from Q2 and Q3, Q4, there are a few big sports events in 2024, right? Starting from the Euro Cup and then follows by the Olympics. And in between, you have the bicycle races in France, and you have many regional marathons or in Berlin or in Amsterdam, etc. So I think 2024, naturally, all those big sports events, which also is one of the kicker towards ourselves, are lined up more into the Q2, Q3 period. Right? And then you go naturally into the Q4, which is a high sales season for us. Right? So that's why we see the sales pattern is going to be more tilted towards the second half of the year, right? Obviously, you should see a pickup in Q2 and then followed by a strong Q3 and Q4, right?
I see. Maybe just
now,
one. Yeah, go ahead.
Let me finish on your question, Marcel. So you asked about the new product sales, right?
Yeah.
So that's why So in CES in January this year, we launched our ring, right? Which is one of the first in the industry. So that's why we have always been talking to everybody that we are a smart wearable company, not a smart watch company. Obviously, smart watch accounts for a big part of our revenue right now, but we're also pioneering and entering into new form factors like the watch, like some other patches, and there are many other new form factors of the products which are lined up towards Q3 this year. So that's why we are quite confident on the journey which we're going to embark on in 2024. It's a big sports year. We have exciting new products lined up more towards the second half of this year, which also caters for the high seasons of the CE industry. And then we believe that 2024 should be a better year versus 2023. You already see the trend of 2 consecutive profit quarter in 2023 Q3 and Q4, right? I think we want to, at least the management of the company strives to continue this trend into the 2024.
All right. I've got one more question related to this regarding the product strategy, because you mentioned this overall transition away from Xiaomi, right? And margins going up, and also the average sales prices are going up. Now, this seems kind of be a premiumization strategy in a way, because you suddenly compete in a, let's say, $200 to up to $500 per item areas, right? Which is also, to be frank, quite untypical for Chinese companies. I'm seeing similar stuff, for example, in the EV industry, which I'm also covering, and there we also have this overall theme of deflation and consumers who are looking for cheaper goods. And so I'm wondering, and I'm not sure whether or not you can share anything of that, but whether you also have products in the making that are meant to even replace Xiaomi in terms of products, which are found more in the, let's say, mass market segment, because it seems to me like you're now prioritizing profitability and the higher revenues per item segments. But are you also thinking about expanding back into the mass market segment, which seems to be faded out right now, or is this something which you won't touch in the future?
Yes and no, Marcel. So let me also try to rewind a little bit, right? I think we are a pure player on the smartwatch segment. And in essence, you can see that, and I think I also mentioned in the previous calls, which with you as well, within our product lineup, we have very simple 3 lines. And just to remember, at the top is for sure the Garmin killers, right? In the middle is the Apple Watch and Samsung Watch killers that you think about the Balance line and the Active line, which I just mentioned, right? And we still have the so-called Xiaomi and white label products killers, which are positioned at the price band between 60 to 100 bucks type of price range, where we have the BIP 5. Right, so that's our BIP series, which we are selling all over the world, in United States, in Europe as well. So I think yes, the reason why we categorize our product department into these 3 killers type of thing for you to understand and for your viewer to understand is to actually capture the different potential in those price segments, right? And why we believe we are on one hand improving on the ASP and the gross margin, and on the other hand, we are able to actually penetrate more into the different domains of and versus our competitors. I'll give you one example, right? So if you look at Garmin's flagship watch, which is Phoenix, right? I think rough number, it's being sold at around $1,000 per piece, right? Our T-Rex product and then our flagship line, the T-Rex Ultra, for example, right, is only sold for less than half of that price, but with 95% of the functionalities, and we're improving on those functionalities from a software perspective every day, right? Because one of the observations, if you look at the independent third parties review per se, they definitely noticed a change for our company in the course of 2023, that we push out OTAs very often, and we actually improve on the different sports functions, especially our running and outdoor ranges. For example, if we're entering into a ski season in Europe, we'll launch the whole ski functionalities in our outdoor series as we entered into that season. And also we provide the offline map functionalities for people to navigate. Right?
Mm-hmm.
So I think that's just one example on how you should imagine how we compete with those guys. So with Garmin at half of the price versus their flagship products and 95% of the functionality. And in the end, yes, it's also generating a quite healthy gross margin for us as a company, right? And if you go one level down, you have the Apple Watch, the cheapest Apple Watch SE, right? It's positioned at 240 euro or $240 per piece, if I remember clearly. And we are actually on the active range. We have the Square Watch as well, which we only priced at half of that price, which is 129 or so, right? With I think more than 90% of the functionalities and accuracies as the Apple Watch. So I think this is the strategy, how we play on the different price segment and also how we play with our competitors against the industry. So the only thing which you probably cannot compete from a price perspective is that 60 to 100 bucks price range.
Mm-hmm.
But what we do is that because we have a vertical integration and we have our OS, our operating system, right? So we could actually give the also the very low end products the same look and feel and also the functionalities from a software perspective, similar to the ones which are looking at the Apple and the Garmin the premium functionalities. Right? So that's why we think even on the low end product range, we are able to sell and compete because yes, you're positioned at the same level versus your competitors, but what we offer to the user, the value to the user is much more than what our competitors can offer. Okay?
Got it.
Yeah.
Okay, let's move on to the fundamentals, the report again, and your third point, which is operating cost for the quarter is 200 million RMB, which is much lower than the run rate of 300 million per quarter for the past year. We continue to monitor the cost and bring it to the level of 200 million or lower for the coming quarters. So let me phrase it like this. Should investors be worried that you are kind of starving yourself to death in terms of let us know where is the cost savings coming from, and is it maybe too much and also therefore sacrificing so much or some of the growth and the opportunities out there? So what's your view on that?
So I think, Marcel, we talked about this before, right? So I think the 200 million, if you look at the breakdown, we have been doing that across the year for 2023. And if you zoom into the number which we disclosed on a quarterly basis, R&D, G&A, and marketing, you will see that we still spent significantly on R&D and marketing, right? Because we believe these two are long-term levers to actually generate the returns for the company. Now, on the other hand, we have the levers which we can improve on productivity of the company, especially on the R&D side. Now, the levers comes from 2 or 3 places, right? Number one is platforming, right? Because we, as a pure player, we can actually build a platform for our premium watch, for example, and then you can instantly use that platform for what we built for the Garmin killers onto the Apple Watch killers, and then even onto the Xiaomi and white label type of brand killers, right? Because the charging component is more or less the same. The screen sizes across the line is more or less the same, and we have our own chip which we built for our wearables, and this actually you also benefit from the vertical integration we have to actually improve on the R&D efforts. So that's number one. Now, platforming definitely help to improve the productivity. The second thing which we are able to do is that we have embraced AI fully in our day-to-day work, not only to the visible AI functionalities which we push to the user, use the natural language model to talk to the watch, and then it will just do things in a very smart way. Right? I would recommend you to try out, because we launched the first one in the industry on the AI based on the natural language model to navigate and ask your watch to become your personal assistant per se. Right? You don't have to remember any of the predefined commands. You don't have to actually trigger anything. You can just talk naturally, right? And then the watch would just do and perform the functionalities from checking the weather, or to set up an alarm for you, or to give you insights on what's your previous night's sleep quality, or give you insights or coach on what you need to do the next day based on your previous day's readiness score in order to become a better self. Right? So I think that's not only the functionalities which we give to the user, also in our day-to-day coding and programming work, we are able to use AI to improve our productivity on the R&D side. Right? So I think those are the two things which we did in improving our R&D efficiency, and also at the same time, we didn't sacrifice too much, because from an absolute amount and from a percentage as a sales perspective, you will still see that we spent heavily on the R&D and marketing efforts for the company, because we believe that is the right thing to do, and we're an R&D driven product company. Right? So that's what we are here for, because we still believe that on certain in certain areas, certain domains, our watch is on par or even better than the Garmin and Apple and Samsung watch. Right? So I think it's in a nutshell what we did. I think it's improving R&D efficiency. On the marketing side, you heard me talking. We actually pruned on the channels which does not generate a return. Right? Obviously, we're not going to touch the strategic ones, but if you think about those small stores, the mobile phone repair stores, which you can easily find in the streets of Berlin, that type of stores is definitely not the place to sell a smartwatch. Right? So that's something which we did, but we are actually investing heavily on the marketing efforts. For example, we sign up the Amazfit athletes. We are more and more visible on the sponsorship in big events like marathons. We actually sponsored the Rotterdam marathons, which is going to take place in April in Rotterdam in the Netherlands, which is a big event. We also is going to do more in the sports year, and you will see that also in France we did some collaborations with Decano because they are also refreshing their brand, and also they are actually more getting into the lifestyle, the outdoor and the sports range, which are very close to what we're doing. Right? So these are definitely the opportunities, and we are continuing to invest on the marketing capabilities and the building of the brand. Right? Yes, and you will notice also on the G&A side, we cut it heavily. Right? Because we want to be lean enough in order to give more space to the front line operations, be it marketing, be it R&D, so that they can invest. Okay? So I think that's in a nutshell what we did in the past year. Yes, AI helped us a lot. Yes, platforming helped us a lot. And we continue to invest on the brand awareness to propel the future of the company.
By the way, those AI services are currently a paid service, or are they free for consumers?
They are free for consumers, but I think we started in US because it's more natural language in English to start with. So we started in US and UK. We are rolling out that functionalities in Europe as we speak. So I think most of the watch users, if you have a balanced watch, you will get that over-the-air update very soon, right? And then we're going to launch that and scale that in Asia Pacific later. Yeah, because those are very difficult languages on the natural language model. Right? But then it will be there. Yeah.
Cool. Okay. All right. Let's check on the details of profitability, which might need some explanation, especially to those who are maybe not so super familiar with the details here. You may just read the headlines, and they might be confusing whether or not ZEPP is actually a profitable company and how profitable it actually is. So you delivered another non-GAAP net income positive quarter, 2 consecutive profitable quarters in 2023. Adjusted net income reached RMB 4 million, 0.6% of sales versus a loss of 60.3 million in Q4 2022. An improvement of RMB 64 million versus 2022 in the fourth quarter. And we have provided a value allowance of RMB 25 million in Q4 2023 for the deferred tax asset write-off, which is a non-cash in nature. Excluding the DTA write-off, our profitability is better than 2023 Q3. Operating profit comes with a higher gross margin and lower operating cost. I think another thing that we might have to explain in this context is also that you are keeping on repurchasing some of the debt, right, or repaying it.
Correct.
So overall, give us your view on the financial healthiness of the company currently in terms of profitability and cash flow.
No, I think we're very healthy, right? So, yeah, but okay. As a CFO, I'm biased, right? No, but let me recap a little bit. I think the gross margin is one of the lever to for us to deliver a profitability in a longer run, right? So that's why we're very much focused on keeping a gross margin and improving on that gross margin. You notice that we in Q3, I think after the press release, everybody was happy. We turned the corner, right?
Yeah.
We turned the corner because our gross margin in Q3 hit 33%. And then so from the Q4 perspective, we hit 35%. So I think if you ask me, for sure, I think Q4 we operate or execute better than Q3 on the gross margin perspective. On the cost side, yes, these 2 quarters we stayed at or below the 200 million run rate on the operating cost I just mentioned, right? Then with a higher gross margin and lower cost, you naturally would churn into profit, right? I think what it's easily people would get confused on over the headline is that there's a GAAP income, there's a non-GAAP income, there's adjusted EBITDA. Most of the companies does that, but then for our company, we only talk about non-GAAP and GAAP, right? So the difference between non-GAAP and GAAP is the share based compensation, right? So basically what you give to employees in the form of shares, that is the only difference for us between non-GAAP and GAAP. So excluding that, we delivered a GAAP profit, although very small in Q4. That's why I call out there was one accounting provision which we did to the magnitude of 25 million RMB or $4 or $5 million, right? Because this is Q4 full year number because it also closed our calendar year annual year report. And then, auditors, once it's a year-end audit, they would go through the book very carefully. If there's things you need to take provision, if there's any things you need to make a non-GAAP provision for. And DTA is one of the topics which, from a prudent perspective, accountants would do, right?
Mm-hmm.
So I don't know if to what extent you understand DTA, Marcel. Probably it's a little bit too much of a requirement for the readers or the viewers to understand that. But I will just spend in very simple language on what it is. It's because if you are making in any of your subsidiaries, if 1 year you are making a loss, it's like doing your tax return, right? This loss could be offset against your future profit if you ever come to a future profit, right? But then there's a time limit on how many years you can use that. And most of the time, if the accountants, they come to, and unfortunately, although we had 2 consecutive quarters of profit, it was not good enough to offset the Q1, Q2 23 losses which we posted, right? But we significantly reduced or narrowed that loss versus 2022. So that's why I think if you ask me, I'm quite happy on what we have executed in 2023. So from a net profit perspective, number one, we narrowed the losses, which we did, although we still post a small loss for 2023. But we see the light at the end of the tunnel because you have already seen 2 consecutive quarters of profitability from us, right? So we believe if we execute on this path, sooner or later, because it's just a math problem on by what time you will turn into a profit, right? We believe that in 2024, there's a very high chance that we would go back to profitability based on the current trajectory and all the opportunities we see at this juncture. Yeah.
Right.
So,
No, that's very good.
So I think you also want me to touch on the balance sheet part, right? So I think I already talked about the P&L part. So coming to the balance sheet, I'm even more optimistic on what we have executed because on the balance sheet part, if you want to improve on your cash, there are only 2 levers you can pull. Number one, you make a profit all the time. Number 2, you improve on your working capital efficiencies, right? So you make sure that the AR is connected faster, the AP which you purchase from your supplier, you can pay them later. Then automatically, the ideal part will be you even have a negative working capital, which means your accounts payable it's bigger than your accounts receivable. Then in essence, it means your supplier is funding your operations, right? We were not there, but I think we did a few steps to actually try to improve on how we operate on the working capital. That's why you saw that inventory every quarter, we actually improve on the inventory performance. And the inventory, I think by the end of 2023 stands at 600 million RMB-ish, and that is the lowest in the history for the company, if you go back on the quarterly result. So obviously, we also improved on the so-called cash conversion cycle. In the past 6 quarters or so, even if in we posted in 4 quarters a loss, right? Our operating cash flow has always been positive for us, right? That's why you saw 2 things. Number one, the company's cash and cash equivalent stays at above 1 billion RMB, which is around $150 million, right? That's why I also don't understand why our company's market cap has been valued so low. I mean, you probably will come to that. Number 2, the working capital as well as the inventory balance has been very healthy and it kept on going down. That gives me the confidence that from a cash perspective, we are generating a positive cash because in the end, P&L is an illusion, cash is a king, right? So and we use the cash to make the repurchase the share buyback, and we'll continue to do that because we're confident in our strategy, right? And to remind you, we also have reduced our long-term and short-term debt in the meantime, right? So if you look at company's balance sheet, this year we have reduced that balance of roughly 200 million RMB, right? Number one, we don't have too much debt. Number two, we have reduced 200 million RMB. And if you look at our balance sheet on the disclosure, we don't even have any short-term debt at this moment of time. Yeah, and then so the tower has been pushed away, and we are actually taking the time whenever we have positive cash flow, we try to improve on the balance sheet. So I think that's something we'll continue to do. We'll continue to on our share buyback program, and at a moment in time, we're also prepared to upsize that, right? Number two, we are actually very good, and we try to even make it better on our debt ratios and all the things which are linking with debt, because once I have money, I better just pay down on the debt. Then it can help me to better counter any risks which can emerge in the macro economy also, right? So I think on the balance sheet side, I'm really, really confident. I'm quite positive on how the team has been executed.
All right. No, thanks. That's great. That's exactly why I'm asking you this question, because when you explain it in your words, in your own words, it's really going beyond what you can tell in just an earnings report and a written report. And some of it is also not being asked by the analysts in the earnings call. So I think that's hopefully valuable to those retail investors out there. But you also made a good point. You are biased as a CFO. I am biased as a shareholder of ZEPP Health.
Yep.
So we need to mention that. This is not investment advice. It's just telling our own views on the matters. But I hope it helps people out there to get a better insight. And so, that's why we're doing it here. And I'm also, want to point out some of the negatives, of course, and where I'm personally disappointed, because, for example, when I yesterday looked through the report, and I guess you know this obvious weak spot, but the guidance obviously has been very, very low. And I mean, you explained, I think there was one analyst on a call asking about this, what's impacting it, and you also mentioned it here. Yes, it's seasonal and so on. However, just going back into the company history, I think there's maybe just one quarter in 2019 when it's been as low, around, what is it, 300 million US, so, I think people are worried about this part. Nobody denies that back to profitability is great, but ultimately people are worried about those growth aspects and are wondering, is there something wrong with the products or the marketing or the expansions, or is ZEPP not in the right markets? What maybe more of your explanations here of what you see for the guidance here and how investors should take it in.
So I think number one, Marcel, you can. I would recommend you to look at the IR deck, which we put on our IR website. And there's one chart I like very much, which shows you how the revenue and gross margin has been improved over the past 9 quarters for the company. So we actually made a chart starting from 2022 Q1, and then we move it all the way to 2024 Q1, right? So what you can see here is that yes, in absolute amount, the amount seems to be, the drop seems to be quite significant, from 600 million to 300 million or 350, whatever. But if you look at the bar, so that's why we give 2 colors. We want to show the viewers on the Xiaomi amount, and we want to show the viewers on our self-branded amount. So I think if you look at the decline, one, for sure, it is due to Xiaomi revenue decline, because the Xiaomi band, we have made the decision because it's not bottom line accretive, we didn't want to do it. But obviously, Xiaomi stands as one of our most important customer, and then also how these type of things go with Xiaomi, because I think you probably also know Nightbots, the company who is making the vacuum machine, the Roborock. These companies, they had a similar background versus us. The Xiaomi products obviously work in a way that every year there's going to be a refresh, and then all the Xiaomi ecosystem companies, and we're one of the biggest, would have a chance to build it for 1 year and stop for another year, and maybe the next year we start to building it. So I think we want to first change the company to a self-reliant company based on a Amazfit brand. That's a journey we have been going through. The next step, at certain moment in time, maybe we'll pick up some revenue from Xiaomi again, but then at least that will not be bottom line detrimental to the company. Okay, so now, but I think, for coming back to the question on what's the 3 and 350 million which we have guided, it looks on paper very weak. Number one is because of the Xiaomi part which we get rid of, right? And there's only a small part left with Xiaomi. I mean, and which we only will do because we want to actually have a win-win between the two parties, right? So we still have cooperations with Xiaomi, but that's no longer the biggest part of the company's revenue. Yeah, and if you exclude Xiaomi, this drop is actually to the magnitude of around 15 to 20% versus last year, if you really do an apple-to-apple comparison on Amazfit. Okay? And that is actually related to a few issues which I just mentioned. Number one, we don't have any new product launches in Q1. It's all this year. It's shifted more towards Q2 and Q3. Last year we have some products which we also launched in Q1. If I remember well, GTR Mini was launched in Q1, right? So it has something to do with the product launch windows of the company. Not every year is exactly the same, right? It has to do with the seasonality for sure. There's a softness in in Q1, right? It also has to do with some of the but it's a minor issue, that some of the marketing efforts which we intended to invest in Q1 didn't materialize. Okay, I mean, there's a tragic thing. I hate to mention that all the time, but some of your users, probably our viewers, know that we have signed up Kevin Kipton, who is likely to break the world record of 2 hours in Rotterdam in the upcoming April, but unfortunately he passed in February. Right, so that obviously we have a plan B and we're working on those things, but it also takes time to materialize in a marketing effort which can boost our Q1. Okay, but we're confident that as we enter into Q2, Q3, Q4, we should be able to recoup some of the losses which we had in Q1.
All right. Thanks for your explanation. And by the way, the figures that I mentioned were in RMB, not USD. But anyways, you mentioned already share buybacks, and let's maybe zoom out again to, as we've now discussed the fundamentals, but maybe I think what I'm seeing, at least in some of the minds of the retail investors out there, worries about where the company is trading in terms of stock price and valuation and so on. So I think you have just stated you are doing buybacks, right? And I think we've stated that one before in a previous interview, that you are limited to the volume. I think around 20% of the daily volume that you can actually
10%.
execute.
10%.
All right. Yeah, and that being an issue, that there is actually even quite low volume, right, as well. Okay, so yeah, on the one hand, we have the commitment for share buybacks and so on. On the other hand, I mean, if I'm thinking from your perspective at this point in time, couldn't you just take the company private and buy out the investors because it's so cheap? Or could there be somebody else interested in buying you out? And where would this leave investors like us, right? So can you share any light on this?
Yeah, no. So, Marcel, number one, I think no. We believe that our main market is in Europe and the United States, and we're an international company, and you can see our products everywhere. Number one, we really believe that our valuation is undervalued, right? So that's why, okay, I can see where that come from. There could be a blip of guidance or whatever, but I think this is very temporary. As a management of the company, we believe in our strategy, and we believe that, but it's only a hypothesis from ours, is that if you look at the share price reaction in Q3 after we announced that we turned into a profit, you see the price action, you see the share price actually in a certain period of time actually shoot up to it doubled, right? I don't think the share price should stay at this low level, but I think people and our investors are waiting for a moment to invest in us. I think this is the moment, right? So I think if you ask me, for sure we don't want to prioritize the company at this moment, even if we could, right? Because that will just leave all the retail investors, including yourself, with a small positive of 20%, but then you probably invested at a much higher price, right? I think what we are trying to do, I think it's a hypothesis of me, this is only my opinion, is that number one, people, the share price is at what they are right now. It's because people probably didn't see a clear path of this company as a going concern, right? They think maybe the competition is fierce, and then the company is keep on making losses, and at certain moment in time, the cash will burn out, and then the company will cease to exist. That's only my hypothesis. That's why I'm trying to tell you and all the others that no, even if when we make a small loss in the past 2 years or so, every quarter the cash flow is a positive operating cash flow. Now it's an inflow of the cash flow, because in the end, cash flow is the thing which I'm looking at very closely every day, right? So I think we have the runway, we have the cash flow to invest for the future, and we believe on the strategy which we just discussed over the past hour or so, that the flying will start to take shape. And then we believe if we could consistently deliver on the strategy which we set out to do, mind you, Q1 probably is a blip. And if you look over it in a longer term, let's say if by 2024, at least our expectation, I will get back to that in a bit. I think you will probably even ask me what's my feeling on 2024, right? If in 2024 we're able to turn the corner and make a full year profit, I think this company will be positioned and revalued and will have a great future, right? And then the share price would for sure correct by itself, right?
Right.
So I think that's my take on it, but it's only my own opinion.
Yeah, exactly. I need to emphasize again, that's your personal opinion. It's not investment advice. I'd like to add one thing, which I personally take as a reason also why I invested in the company, which is that it's a founder-driven company. So maybe some people might not be aware that I think, I haven't checked the exact numbers, but around about 1/3 of the company, 30%, I think, is in the hands of the founder, of the CEO, Mr. Wang. And usually that's also a strong hint for a long-term view, strategic execution, and also he would ultimately decide to give up on his baby. That thing would need to
No,
happen.
it's like Elon, right?
Yeah.
So he is able to take a long-term view on the business and admire that, right? Because we always, as a joke, compare our company with some of the multinational companies in Europe, for example, right? And then all the CEO, CFO, and everybody in the management team, they're just professionals. I mean, all they
Exactly.
care is like taking short-term decisions to maximize their bonus pool, right? And after 5 years, they leave, right? And then nobody cares about after 5 years whether this company has a future. But we and I can tell you, our CEO involved in the day-to-day business very deeply, and he is really passionate about the industry and about the things which we are doing. And then he's also has a vision whereby he want to improve people's life, right? So I think I admire that a lot, right? So that's why I worked for ZEPP Health as his CFO, right? And I do believe that where some of the decisions we decide to look past 1 quarter or two.
Right.
But yeah, that I understand is probably not good for a retail investor as yourself. But I think even if you look at Nvidia's past, right? These guys. Now, okay, I will rest my case.
No, I see. Like, I mean, many retail investors are being tested in these periods, especially if you're invested in Chinese equities. I think that's an overall theme, but also innovation, VC segment, everything that is considered risky is currently down in this situation. And, so it's definitely not a quick buck, but in the end, in the bear market, the money is made if you're able to invest low and sell high. That should be the goal.
Yeah.
But we're not here to talk the trading advice. Instead, let me finish this interview because I already taken 1 hour of your time with let's say a high note, because ultimately we are bulls on the company, and maybe go again through some of the catalysts for 2024, but maybe also beyond that. So I think you mentioned that you have new products like the Helio Ring coming up. You have mentioned a couple of sport events that are coming up. Definitely still some work to do on how to come up with a plan B for the unfortunate
we have very interesting products which is in the pipeline. I
Okay.
think some of that, even in my mind, I could regard it as new to the world, right? So that will launch in Q3, and you should be able to see it. I'm very excited on the products which we're going to launch, and as I said, it's not limited to a watch, so it's going to be a different form factor, right? And I think we want to be the wearable company which actually be everywhere on you, right? And which can give you insights on how to train yourself better, how to rest better, and how to be a better self. Right. So think about some of you may not know in United States we have the hearing aid business, but it's still being treated as an incubator business, right?
No, that's perfect, because I actually just wanted to ask you a little bit more about the ecosystem, because it always sounds we're just talking about watches and wearables, but there is so much more to this company, right? So services, the ecosystem, and your initiatives like your investments. Maybe if you can shed a little bit more light on this as well, as far as you can. That might be long term, beyond 2024, but I think people should be aware.
Yeah, no, I think we have the hearing aid business in US, which is already being sold, right? And that form factor of the hearing aid, you can think of that it's a very specific form factor. Basically, it's called in the canal hearing aid. So a lot of people, when they get old, because you will only have hearing damages once you aged a bit, right? Not for us, but for some of the elderly person, once they have hearing aid or hearing problems, they refuse to use the hearing aid. That's why we developed this form factor to have it in the canal. So basically, you're wearing something like a mini version of Apple AirPods, but inside your canal, which other people will not even notice that you're wearing anything. Yeah, but you have a hearing aid in your canal, right? So I think that business is setting foot in US, but it has a different go-to market model, which has not generated a significant value yet. But then alongside that business, we have also new form factors of the devices, which you can expect in the later second half of the year, which is around the ear, right? And then we have the ring, we have the watch, and not to mention the algorithms we have on the services side to coach you on how to run a 3K, 5K, 10K, ultimately to a marathon, and the AI that flow we just talked about earlier in our call, and also the functionalities to help you sleep better. The AI generated music. Now, those are paid service, so I'm not going to elaborate too much on that. But then if you look at it, the company is really having a few verticals from the own chips, long standby time of the watches, and we're compatible to iOS and Android, right? I think that's a big plus because now Samsung Watch only works with Android, Apple Watch only works with iOS. The only comparable guy you can find probably is Garmin, similar to us. And then we have our OS, which is an operating system with own apps in the App Store and a lot of third-party collaborations, for example, with Strava, with Komoot, etc., etc. And we do it. We also localize those, right? And we have the different algorithms and paid services. And on top of that, we have different form factors. I think the company is well positioned in the wearable domain, which for sure has a bright future. But again, I'm biased as a CFO, right? Yeah.
All right. Yeah. Thanks, Leon. I hope some of these initiatives, which you just mentioned towards the end, will show up ultimately also on a balance sheet that we can hopefully talk about those revenue streams and margins as well. Similar to, you just talked about clarity, but also maybe some other services, even hopefully in the B2B segment at some point, or the medical device industry as well. You're also active, but well, maybe time for another call another day. I thank you for your time and elaborating in detail on these specific topics. I hope it was valuable to the viewers. Let us know in the comments what you think of it. And then, maybe next time we'll see each other in China, and looking forward to it. Thanks again. And thanks everybody for watching.
Thank you very much, Marcel.